I'm Peter Lang, Managing Director and Partner here at Hightower Westchester. Today, I'm going to be talking to you about required minimum distributions from your IRA account and how using qualified charitable distributions, known as QCD, from your IRA can provide some positive tax impacts. Let's start with the RMD and some facts and how they work. In 2024, if you are 73 or older, you will be required to take your first RMD. You may remember that for a long time, RMDs started at the age 70 and a half, but in the two different Secure Acts that were passed in 2019 and 2022, those ages were increased. But in a quirk, not the age for QCDs, but we'll talk about that a little bit later. In addition, in the Secure Act 2.0, the RMD age will be increasing to 75 in 2033. So if you were born after 1960, you will need to start taking RMDs at age 75. Let's talk about how RMDs are calculated. It's really pretty simple. We take the value of your IRA from December 31st of the prior year. So in 2024, we take the value of your account of December 31st, 2023. That number becomes the top number from your math days, or the numerator. We then take your age. We go to an IRS uniform life table and find the corresponding distribution period, and that's your divisor. We divide one into the other, and voila, we have your RMD amount. That amount must be taken by 12/31 each year. The only exception is the first year that your RMD is required. In that particular case, you have until April 1st of the following year. But keep in mind that if you defer by these few months, you will have to take a second distribution in the following year. So for example, if 2024 is your first year, you could defer until 2025, take one distribution by April 1st, and then a second distribution by December 31st. It's generally not something we recommend, but it's something that can be considered. When you take your RMD, we can withhold taxes at the source for both federal and state tax at whatever rate makes sense, which reduces the RMD amount. For example, if your RMD is $20,000 and we withhold 20% for federal tax, you have a net of $16,000. Or you can elect to have any amount withheld or not withheld, and if so, probably advisable to pay quarterly taxes throughout the year, or you can simply pay it in April when you file your taxes. Once you have your RMD, a common question we get is, well, do I have to spend the money or can I invest the money? Once you take the RMD, that's the taxable act that the IRS cares about. What you do with the funds when you receive them is up to you. And remember that no RMDs are required from a Roth IRA, and that any withdrawal from a Roth IRA is tax-free. Now let's dive in and talk about QCDs, qualified charitable distributions, and how they work and what role they can play in your tax and charitable planning. QCDs were established in 2006 in the Pension Protection Act. They were a way to make payments to charities directly from your IRA, charities of your choice, in any amount. Currently, the maximum you can do in any 1 year is $105,000 from an IRA, an inherited IRA, inactive SEP IRA, or an inactive simple IRA. Now let's go over a few facts about how they work. In a little glitch, when Congress passed the first and second Secure Act, as we mentioned earlier, when they increased the age for required minimum distributions, they did not change the corresponding age where you could start to do QCDs. So the QCD age remains at 70 and a half, while your RMD age is now at 73. Congress had a chance to correct this in the Secure Act 2.0, but for whatever reason, they did not do so. So again, you can take a QCD of up to $105,000 in total in any one calendar year. Let's say, for an example, your RMD in 2024 is $20,000. You can take any or all of that amount as a QCD. Or you could even take more. You could take the full $105,000 as a QCD, and I'll talk about that in a second. Now let's say your RMD is $120,000. you can only do up to 105,000 in the QCD, and the remaining 15 would be taxed as a regular required distribution. So now, what are the tax advantages? Let's use another example here of your RMD is $40,000. Let's say you decide to donate all of that to your favorite charity or charities in whatever amounts you choose. You simply provide us with the charities. We have you sign a form. We either send the check to you or directly to the charity. Let's use the example, and let's say your name is George Costanza and your favorite charity is the Human Fund. You ask us to provide a check for $40,000 made payable to the Human Fund, and you can then pass that check along directly to the charity. Unlike a normal charitable donation, no tax deduction is received by you, but you also don't have $40,000 of taxable income. So your taxable income is actually lower than if you took the RMD and then separately made the same donation. By keeping your income lower, you may end up in a lower tax bracket. And by choosing to make a larger donation, let's say $105,000 in 1 year, you end up lowering the value of your IRA, and therefore your future distributions are going to be a little bit lower because you took out such a large amount in a QCD in 1 year. One small little tip. It's important to know that currently, most IRA custodians that we know of do not provide the QCD amounts to you in the normal tax forms that they send to you in January, either the 1099 or the 5498. So you need to remember that you did a QCD. Simply tell your CPA or tax preparer how much of a QCD you took, and there is a checkbox on the 1040. Your CPA will enter the amount of your RMD and then the amount of the QCD, and one will offset the other. We provide our clients with a letter in January reminding them of the QCD they did in the prior year. Maybe someday the custodians will make this reporting adjustment, but until they do, please be mindful and put a note with your tax forms. We hope you found this videocast helpful and useful in understanding both RMD and QCDs. Please feel free to share this content with your friends and colleagues. And more importantly, always feel free to reach out to us at Hightower Westchester to learn more about this or anything else. Thanks so much. Have a great day.
Hightower Westchester is a group of investment professionals registered with HighTower Securities LLC, member FINRA and SIPC, and with HighTower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities LLC. Advisory services are offered through HighTower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. Hightower Westchester and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of Hightower Westchester and do not represent those of HighTower Advisors LLC or any of its affiliates. HighTower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.